What's up, everyone? This is Andrew here with Spark Finance. And why is this term, the SPAC, becoming so big on Wall Street and in investment circles, right? What is a SPAC? That is going to be the main topic of today's video. So a SPAC, also known as SPAC, standing for a Special Purpose Acquisition Company. This is the main point of the video, to explain what this is, where it came from, and why is it so big now in the last few years. The short answer to what a SPAC is that it is a shell company that is publicly traded and has the sole purpose of effectively merging with another privately traded company, thereby making that company publicly traded. And that allows them to avoid the whole long, arduous process of having a traditional IPO and becoming publicly traded in that manner. So they're making it easier for those companies to become public. Now, a little bit on the behind the scenes of this process and what is going on exactly. The SPAC becomes publicly traded, has their own IPO, and they have a stock ticker symbol. But it is just a shell company. The goal is to wait until a new, great, and up-and-coming privately held company wants to become publicly traded and raise some capital, and then the SPAC comes in and does a merger with them to fulfill that goal. Now, growing companies, they want to become known as what is a publicly traded company, which means you can just buy their shares of their stock on one of the public exchanges, such as the New York Stock Exchange or the NASDAQ. You can buy the shares on Robinhood or your brokerage app or wherever. And this opens them up, the company, to a lot of new investors and capital coming in that can be a lot more than what they can raise in private terms with venture capital. Legally, they're also restrained to having 2,000 or less owners of their company. So when they get close to that mark, they need to become a publicly traded company. Now, the SPAC itself, that doesn't have any business operations. It is not producing any products or services for the marketplace. The assets that the SPAC has are usually just the amount of capital that they were able to raise in their own IPO that they hold on their balance sheet, just waiting for a merger opportunity to happen, and then they pounce on that company. So SPACs usually go public at around $10 a share, usually $10 specifically, and maintain around that price until a merger. And remember, this is the sole purpose of the SPAC, to use the funds they raised to find a company to merge with and make the other company a publicly traded entity. SPACs are also known by the term blank check companies because they're basically writing a check for another company that already has a good business model. Now, when the original round of investors purchases the SPAC IPO, they have no idea what they are actually going to be investing in, what the SPAC will eventually merge with or take over. They are just betting on the owners of the company, of the SPAC company, making a strong choice, a good decision there on what company to merge with. And that is why you see a lot of big hedge fund managers getting into this space, because they are the ones that people have confidence in to make the right choices. The owners of the SPAC, they then usually have a contractual obligation to make this merger within the next 2 years. And if they don't, they just pretty much liquidate the SPAC and give shareholders back all of their money with a little bit of interest if they can't find a company to do their merger with. Now, when a company such as Opendoor or PaySafe or Fisker or Virgin Galactic or DraftKings, they decide they want to become a public company, and people want to become a public company because, again, it raises a ton of money for them. They have been going for this SPAC route rather than having a traditional IPO or initial public offering. And that is something that is taking basically the world by storm now in 2021 here. The SPAC company they do an acquisition of the target company, and they either change their shares to shares of the newly merged company, or the SPAC shareholders get paid back for their initial investment as well as some interest. The SPAC usually maintains a position of around 20% in the final publicly traded merged company. They also usually change the stock ticker symbol to match the company that was purchased here. So you could see that in the case with Fisker or DraftKings. Now, exactly what are they doing here? Like, why are companies doing this? And why is it always in the news? It seems like every week in the news, we are hearing about a company that is privately held and wants to go public for a capital raise, right? That's what they want, is a capital raise. They are expanding and they need that giant wave of money that comes in from an IPO to continue to build and grow their business, to help fund it. Now, the problem is, of course, that to set up a traditional IPO, that takes a lot of time. It could take, 6 months to go through that process, as the world is just passing them by. So there's also a lot of compliance that they have to meet for the traditional IPO. Alternatively, with the hot and spicy SPAC, a company could become publicly traded in as little as 3 months. That's about half of the time there to become a publicly traded company, and they sidestep a lot of the administrative process on it. There are a few major factors on why SPACs got so big between 2019 and 2021. One is, of course, because of COVID-19 and the pandemic arriving, a lot of investors and companies were unsure of how the market would react to new IPOs. And also, there's older laws out there, such as Sarbanes-Oxley from back in 2002, that made it much more of a rigorous process to launch an IPO and cover all those administrative burdens. It is also important that as interest rates have been at really very low levels for a number of years now, money is moving towards higher yielding returns, and at the same time, money can be borrowed on the cheap by these big funds. That's another factor of why this became so popular in this short window of time. But of course, you want to see also what is the history of this, and what is the current state versus how long have these things been around? Like, where did they come from? How did they just blow up out of seemingly nowhere? So SPACs have raised $95 billion in 2021, which is an all-time record. And they now account for a whopping 70% of companies becoming publicly traded this year. That's pretty insane right there, to go from even just 2 years ago, I believe SPACs accounted for only 22% of the market. And now it's 70% going up. So they are accounting now for the majority of companies becoming publicly traded. So that's a giant shift in the marketplace and how companies are doing business, right? So if you look at the original investors, the original inventors of the SPAC, an investment banker, David Nussbaum, and lawyer David Miller, they came up with this idea of the SPAC to basically allow private firms access to everyday investors. That was the original idea, or the original vision that they had. So they also, I think this is important to bring up too, that they came up with this idea back in 1993. And you see, it didn't become popular until just recently. It was always a small part of the market until they just exploded in these last few years. And another important thing to think about here is that they did get a little bit of popularity in the 1980s, but not for a good thing, right? They were actually known for what is called blind pools. And these were types of investment vehicles that were used in the 1980s for penny stock fraud. So a lot of people thought that SPACs were very negative for the longest period because of the frauds that were taking place around the penny stocks there like that. So I thought that was an interesting thing. And then now the mindset has kind of changed, and here we are now. Now, of course, there's warning signs that we have in the marketplace with what's going on, right? What does this tell you about the market right now when these special purpose acquisition companies have become so popular, right? Maybe it shows that the rules around the traditional IPO are so strict and cumbersome and antiquated that companies rather just avoid it entirely, because the companies need capital, they need money to keep growing their business, and they want to do it in the simplest way possible, and they're sidestepping the traditional IPO. Maybe that actually means that there needs to be new rules established to stop companies with potentially shady fundamentals going to this SPAC route to become publicly traded and avoiding the whole IPO audit scrutiny process, right? That's another thing that they're doing here. Maybe this goes to show you that easy money policies in recent years and people moving towards riskier and riskier investments, whether that's cryptocurrencies or collectibles or tech companies or GameStop and AMC and the meme stocks and now SPACs, maybe this is changing the overall dynamic of the marketplace and potentially creating distortions which could lead to bubbles. Everybody's always scared about what's the next big bubble gonna be. And finally, maybe this all means that investors and, well, I guess Wall Street funds found yet another way to work around the rules of the system to come up with a new, huge profit generating business model for the current environment. There's a lot of hedge fund managers and a lot of big individuals and a lot that have a lot of popularity that are utilizing these funds now and making a lot of money for the people that invest in them. So regardless of the reasons to how we got here or why we're here, I'm still Andrew with Spark Finance. So I hope you enjoyed watching the video. If you want to check out some other videos on personal finance and investing and economics, check out my channel and check out the other videos. This is Andrew, I'm out.